Hi, and welcome to the Day Trading for Beginners podcast. This is season 3, episode 10. And in this episode, we're talking about why I am not an all-in Tesla investor anymore. So my name is Tyler Stokes from StokesTrades.com. I am on a journey to become a full-time trader. And over the last 5 months, I've been trading real money and the portfolio is up 84%. So along with those results and some other reasons, I've sort of shifted away from this all-in Tesla investment strategy. And I want to sort of share my story. Now, below in the show notes, you can find a link where I share all my trade updates, my portfolio updates. And in our school group, I actually have a course that outlines the exact strategy that I've been using to make this 84% gain in the last 5 months. Very low stress strategy. I'm not trading every single day. So certainly go ahead and check out those resources. So for years, I was an all-in Tesla investor. At one point, my entire portfolio was this single stock, captivated by its innovation, market dominance, and the thrill of watching its value soar. I started investing in 2020 and I rode the wave at Tesla's huge rise, and I still hold excellent gains. But I realized, this approach came with risks that I really couldn't ignore anymore. And today, I'm sort of sharing why I've shifted away from being an all-in Tesla investor, guided by lessons I wish I had learned earlier. So this change has transformed how I think about investing, and it might do the same for you. Obviously, this is not financial advice. I'm just sort of sharing my perspective and sort of my story. So, the all-in trap with Tesla, this is sort of what happened to me. Like many, I was drawn to Tesla's rise and felt like the ultimate one-stop wonder that defied market norms. I was convinced its growth trajectory, would outpace any diversified approach. But let me be clear here. No one's responsible for my financial decisions but me, and the same goes for you. But, it didn't help that, passionate Tesla influencers had their, compelling arguments about Tesla's unbeatable fundamentals, game-changing technology, and visionary leadership from Elon and future catalysts that were just around the corner. All that stuff had me hooked, and I bought into the hype, thinking, why invest in anything else? I own 2 Teslas. I think they're the best car out there. Robo taxis are just around the corner. So for a while, all that worked, and my portfolio did well, and many other people that were in Tesla did well. But then came the volatility. So sharp dips, market corrections, and unexpected news sent my portfolio on a roller coaster ride, really from 2022 up until even now. The stock has not done much. So that's a big missed opportunity with some other stocks that have done much better, like NVIDIA, 10x over the last few years. So I came across this realization that the hard truth is fundamentals don't drive short-term stock prices. So when the chart is bearish, even the best story won't save you from a decline. A basic look at market structure in 2022, starting in 2022, would have signaled it was time to, pivot or take some off the table with Tesla. But, I was too mesmerized by the narrative. I really knew nothing about market structure. I didn't know anything about technical analysis, about price charts. But looking back, obviously hindsight's 2020. But, in 2022, 2023, if you just knew about market structure, there were signs that you should certainly take some off the table. Now, don't get me wrong. Tesla still makes up a big part of my portfolio. It's my biggest position. I'm really bullish on its future. Here, end of August, Tesla's looking like it's about to break out any minute. Now, I love the company, but I learned that going all in on one stock, no matter how great, is a gamble dressed up as conviction. So if you heavily invested in Tesla or any other stock, this podcast might just make you think twice about putting all your eggs in one basket. As convincing as a lot of the Tesla influencers can be in the whole story, I don't think any really good investors, traders, have a portfolio that is so heavily weighted on one stock. It's just not something smart investors and smart traders do. So the turning point for me really was technical analysis. And that really opened my eyes. When I started, my trading journey, I quickly discovered a price chart. And I realized they tell the story first while fundamentals catch up later. So I'd been, obsessed with Tesla's earning reports and, its innovation pipeline, thinking its strong fundamentals guaranteed success in the stock. But the charts revealed a different truth. Tesla's price action signaled trouble long before any bad news was released. So this was a revelation. I saw that, clinging to a stock based on its story alone left me vulnerable to timing missteps. The charts clearly showed us when the momentum shifted, and that's when I knew, I needed a new approach. Now, one of the hardest lessons I learned was letting go of Tesla's fundamentals. On paper, they looked irresistible. Yeah, it's easy to think with fundamentals this good and a growing list of catalysts coming, Tesla has to keep rising. But, here's another catch. Fundamentals alone don't dictate short-term performance. The price chart does. So I got trapped thinking no other stock could perform as well as Tesla, mesmerized by its story yet. Over the last few years, many stocks have outperformed it by a wide margin. So following the price chart, watching support levels, resistance, and momentum, that revealed, I should have taken some off the table, even with these stellar fundamentals. Also, a stock might kind of look cheap based on discounted future cash flows, but if its price keeps hitting resistance and the market structure is currently bearish, it won't help. So a lot of, people who do research on Tesla, they look forward into the next 5-10 years, and then they discount those cash flows back and they say, hey, the stock should be $1,000. But, if the stock is currently not breaking resistance zones, the market structure is bearish. We have a lower high, lower low, lower high, lower low. All those discounted future cash flow research papers that come out, they aren't going to suddenly blast the stock off. And again, other opportunities with less impressive fundamentals were doing much better because their charts showed bullish patterns. So this shifted focus from fundamentals to price action that really helped me break free from the all-in mindset and sort of seek diversification where the numbers and everything lined up. Now, in my opinion diversification certainly beats going all in. And if you put, most of your money into just one stock, it can feel thrilling when that stock goes up and you make big gains, but, there's always regret when things go the other way. Some of the reasons why you should just diversify, and some of these are really obvious, it lowers the big risks. It helps you adapt to market changes. It can lead to steadier growth over time, and it's just less stressful. And the big point with diversification is that I used to dismiss diversification as something for investors who hadn't done their homework, like those who just settle for mutual funds without digging deeper. And, again, a lot of, the Tesla influencers, they had proven that through their research that Tesla was unbeatable, unmatched innovation, a visionary leader from Elon, and fundamentals that just screamed long-term dominance. And that was my mindset too. Why spread my bets into lesser companies when nothing compared to Tesla? But another, reality check here is, again, we keep saying this, stock prices don't follow the best narrative in the short term. Market dynamics, sentiment shifts, and momentum can make even stellar stocks underperform while others do well. So, my wrong idea about diversification painted it as passive and uninformed, but I've learned that it's actually a strategic tool. So now, I'm focused on building a portfolio of several really strong stocks that have strong momentum identified through technical analysis. And this more active approach lets me capture opportunities beyond Tesla without abandoning what makes it special. And again, I still hold the majority of my portfolio. Tesla is still my largest position. So, rebalancing is not always easy. As of right now, I have sold Tesla in my non-taxable accounts, like a tax-free savings account in Canada or an RRSP to sort of maximize tax efficiency. And I'm happy now that I'm not 100% in Tesla, I might reduce positions further if the risk reward looks better for some other stocks. But, I really want to avoid paying tax. And I'm happy now that I've reduced. I'm much below, an all-in type of portfolio. But the bottom line is basically rebalancing reduces stress, or it has for me, and reduced risk. And those matter more to me now. So I'm happier with my portfolio, obviously not being so heavily weighted on just one stock. And again, this wasn't about abandoning Tesla, but about finding balance, keeping a good stake while exploring other opportunities with great potential upside, based on their charts. And just my trading over the last, 5 months, a portfolio of 20 stocks that I've been trading with this strategy that we show in the school group is up 84%. And during that same time, Tesla, I believe, is up about 49%. So we're outpacing Tesla since April up to the end of August with a basket of 20 stocks, much less risky, and we're still doing better. So going all in on a stock, it's not the best idea, in my opinion. So looking back, being an all-in Tesla investor taught me the value of conviction, but also its limits. The best approach isn't about picking one winner and riding it forever. It's about adapting to changing risk reward dynamics, guided first by the story that the charts tell. So again, today, my portfolio is starting to reflect a strategy where I regularly assess the charts, rebalance when needed, and prioritize diversification over devotion to a single stock. So if you're an all-in investor, whether it's Tesla or another stock, just consider that the market doesn't reward blind loyalty. It rewards flexibility and informed decisions. So start by studying, the price charts of your holdings and sort of think about their risk to reward ratios. Some stocks might look more bullish than others, and it might be wise to rebalance into those. So if there, certain stocks are trending unfavorably, like Tesla was in 2022 and 2023, it would have been smarter, hindsight's 2022, explore other investments. But again, you need to know technical analysis. You need to have some sort of strategy. So I would recommend that if you haven't, go ahead and join our school group and just check out that course. Even if you do more passive investing, that course, just learning the basics of market structure is the simplest thing to do. Even if you're more of a passive investor that just holds a few stocks in a investment account. And if you want to trade as well, like market structure is king. It's the first thing you should really learn. And in that course, we've got a module all about market structure. So thanks so much for listening. I hope that you found this useful, and I look forward to chatting with you in the next episode.